The Commissioner of SARS, he said yesterday government could lose more than 280 billion rand in tax revenues. I mean, that's more money than our health department is going to spend this year. There are huge implications.
Indeed, indeed. Afternoon to you, Stephen, and afternoon to the viewers. It's a massive amount of money, and much larger than any of the earlier predictions of how much we could lose from a tax revenue collection perspective. But I think the implications for this, Stephen, are on two fronts. The first is that this really already shows us that we're going to have a larger than or higher than forecast budget deficit, probably just around 15% of GDP or so. The second issue is that, of course, it's going to require, as we heard in the budget even before COVID-19, a higher borrowing requirement. But it's going to be much higher than even what the National Treasury forecast then. We saw some of the forecasts saying that our debt to GDP is probably going to be around 71% or so around 2022. And Moody's, a few days ago, came out and said it might be around 91%. So you can imagine what that additional debt burden is going to mean in a context where you're not collecting as much revenue as you would like, and where the spending pressures are increasing every single day. We saw the expansion to the social transfers that were announced by the Department of Social Development. And you add to that all of the other expenditures that are urgent that are going to have to be undertaken in the healthcare sector. And you can really see that this certainly does create a fiscal conundrum of sorts.
I mean, it's a fiscal conundrum. But so many other countries are in similar positions. Isn't that important? And I say this because, people are lending us money. We have to pay the money back. We get very worried about how much it's going to cost us. But everyone's in the same boat. It's better with everyone being in the same boat than us being on our own, right?
And I guess, Stephen, that's why you would have seen even finance ministers on the continent and many others, even in the multilateral organizations. So even Muhammadu Buhari in Nigeria raising the same issue over the last day or so, saying there will be some need for some kind of debt forgiveness, especially if, as we've seen in many African countries, I think of Kenya as one where your external debt as a portion of your total stock of debt is much higher than maybe what you have here in South Africa. I think here we've probably got a somewhat of a unique problem, in the sense that much of our debt is rand denominated, and a lot of that stock of debt is actually a South African debt. And so the negotiations around all of us being in the same boat and being able to navigate around this COVID-19 crisis are probably going to take on a much more of a domestic character than, say, maybe some of our other counterparts on the continent who might have to go into conversations with international banks and multilateral agencies.
It's fascinating because for a long time the fact that 90% of our debt was rand denominated was seen as a good thing. It meant if the currency got weaker it didn't matter too much. Now suddenly it might not be as good as we thought it was.
Well, I think, Stephen, fundamentally the principle is that it is still a good thing. It does give us a bit more space to maneuver than what I guess might have been were a different kind of scenario. I think that the big concern, and the National Treasury has flagged this a few times, is that increasingly over the last while they've had to really rely on short-term borrowing increases, and some of that has been debt that isn't necessarily denominated in rand. And you can imagine what happens if you see sharp interest rate or exchange rate movement and the impact that is likely to have on our debt service costs. And I think that is a big issue. How much are we paying year on year in our consolidated expenditure on servicing this debt? And what is the opportunity cost of that? Those are the distributional consequences of taking money, some people might suggest, away from building school toilets or paying EPWP salaries or even building houses, to going to pay affluent bondholders who don't have to take on any additional risk for the increases in the borrowing rates. And I think this is where it becomes important, some of the news that's going to come from the central bank over the next few days, because all of us want to see what yield curves interventions are underway and what's the scale of those interventions and what's the impact on the terms on which the government is going to be able to borrow in order to finance the massive fiscal expectations that are associated with weathering the storm of this crisis.
Okay, let's just talk about a debt spiral. As I understand, that's when you get into a point where really you have so much debt you can't pay it back. You end up using, you end up sort of borrowing to pay back the debt. you could call it Eskom if you like. So how do we make sure that that doesn't happen? And I suppose the first thing is to try and make it manageable. But when it gets to 90% of GDP, it starts to get very unmanageable. All of this is very complex. It requires lots of clever people with very big calculators to kind of try and work it all out. Do you think that it's actually just possible to avoid a debt spiral, or do you think it's almost inevitable?
I think, Stephen, we're not going to be able to avoid a debt spiral outside of having a broad social compact that has an explicit articulation of the trade-offs and some of the concessions that are going to be made by different social partners. And I'm thinking labour, I'm thinking government, and I'm thinking the business sector. I mention this because I think a lot of the negotiation, as many economists have said, around our debt conundrum is going to happen domestically, but it's also going to happen with public sector workers and their pensions and even the private fund management community here in South Africa. And I think if you add to that the other maybe supply side or production consideration, which is that, yes, you can have debt to GDP at around 90% or so. Some countries even go beyond 100. But the big issue is your productive capability, your supply side in your economy determines your ability to be able to pay that debt. If economic activity is not improving, you're not expanding your output, you're not growing your economy, that denominator, which is the GDP, so you have debt on the numerator and your denominator is the GDP, that denominator, the lower it gets, it certainly then spirals out of control the numerator. And I think that's the big issue. When can we get the economy functioning in a manner that is able to get a growth going? But also, I think it also happens in a context that is very difficult, because opening up the economy might also open you up to massive vulnerability on the healthcare side and total decimation of our population or productive workforce in our population. And I think those are some of the issues, and that's the tight balancing act that we need to consider. But the big reality, Stephen, if you take anything away from it, is that all of this has to happen in the real economy, because that's where the sustainability or lack thereof of our debt is determined. In the productive sectors of our economy that employ people, and those people actually going and spending that money through aggregate demand challenge.
Okay. Ayabonga, I'm going to ask just to explain two concepts to me quickly, because we're going to talk about the Deputy Finance Minister and David Masondo and what he said about the Reserve Bank. Before we do that, all right, there's quantitative easing, which I sort of get, and there's printing money. They're not quite the same thing, right?
So I think, Stephen, printing money is a mechanism, right? And often we colloquially sort of put it that way to maybe disparagingly dismiss arguments that are being made on the other side. Quantitative easing in the United States and even in Europe, as we've seen after the 2008-9 crisis, involves central banks intervening in bond markets to go and buy government bonds. And in the Eurozone, it was buying the government bonds of different Eurozone members. And in the United States, it was going in and buying treasury bills in order, I guess, to finance all of the fiscal interventions that would be needed to stimulate and get economic activity going again. Now, what that does, in effect, is that it creates, different circular effects that are akin to printing more money. But the big question is that all of this is determined by market sentiment and confidence, and what determines and influences that is how you communicate. So it has to be clear that our program of buying government bonds in a QE type way will involve bond purchases to a certain amount over a certain period to achieve a certain kind of outcome. It can't be, a open-ended or a blank slate that is then given, because that then has other implications in the real sector of the economy, and we've seen that happen in many other places. But I think many people entertain a very strawman-like argument where whenever quantitative easing or even, using the balance sheet of central banks is discussed, who straight away go into Venezuela and Zimbabwe without really engaging that there were a set of other contextual and conjunctural features of those two examples that might not necessarily be the case here in South Africa.
Okay, so when the Deputy Finance Minister says this, and I mean, two things happen. The first is there's a large group of people who say, you're in government, you're an elected official, you shouldn't try and tell the Reserve Bank what to do, it is constitutional independence. Some of those people say that and then say, but we do agree with what you're saying, and some people just say you shouldn't do it, right? It's one of those moments where he's actually in quite a complicated position. It's important for the Reserve Bank, for various reasons, to at least be seen as independent, and I think we can accept that it is completely independent. And at the same time, he is bringing up something that's actually really important and key to this whole debate.
It's quite interesting. interesting for me, Stephen, how this particular issue during the COVID-19 crisis has been able to facilitate some convergence of people at different ideological ends. I was quite surprised to hear someone like Brian Cantor at the start of this crisis saying we should intervene in the primary market and buy government bonds, which is something that the South African Reserve Bank hasn't done. They bought bonds in the secondary market, and we saw between the month of February and March that was to the tune of around 1.08 billion rand or so, and we're going to see in figures that are coming out tomorrow morning, I understand, how that figure looks like for the month of April. But the reality is that this is a tool, Stephen, that even the legislation, the founding statute of the South African Reserve Bank makes provision for in Section 10, with some limitations to how you use the instrument set out in Section 13F of the same Act. And so already the South African Reserve Bank of 1989 envisaged that at some point in time there would be conditions that necessitate for the central bank to buy government bonds in the primary market, or at first issue, as some people say. And I think the Deputy Minister is not incorrect to raise this issue and say, if we're going to look at the universe of tools that are at our disposal, we certainly can't take this one off of the table. And I also would need to be persuaded by many of those who are suggesting we shouldn't even go down this path, why, in the context that we find ourselves in, unprecedented as it is, and with an economic impact that probably has only one other historic comparator, which is the 1929 crash, why we would not want to consider this. I think the other dimension, Stephen, and relates to something I said earlier on, is that there are distributional consequences for every single rand we collect in revenue and we spend. And it's more of that money is going to go at higher interest rates, and this is where the yield curve becomes so important, at higher interest rates to bondholders. That takes money away from much needed social and infrastructure spending that we need to get our economy growing once again. And so it's critical in the short to the medium term now that the Reserve Bank is able to intervene and I guess exercise some intervention to contain the yield curve rises that we've seen, and we saw this in the month of April and towards the end of March, where there was a massive sell-off of emerging market equities and bonds. And many people have said something similar is set to happen in September. And so we can't, in that context where we're going to see all of this instability and liquidity challenges in our capital markets, not have on the table the option for the much-needed fiscal expenditure to also be financed through monetary mechanisms.
Ayabonga Cawe, thanks very much indeed. Really do appreciate the time.